Let's continue seamlessly from the previous lecture, and let's focus in this lecture on the liquidity try-up as well as the resolution of the GFC. During the GFC, liquidity dried up across global financial markets largely because of asset-liability mismatches, as we heard, especially in the banking and shadow banking systems. These mismatches created systemic vulnerabilities that led to a sudden breakdown in trust, funding markets, and interbank lending. Here is a clear breakdown of why liquidity vanished and how policymakers responded to stabilize both the banking and shadow banking sectors. Why did liquidity dry up? As we heard, at the heart of the problem were deep asset-liability mismatches, exposing funding fragility. Banks and shadow banks financed long-term illiquid assets with short-term liabilities, to reiterate that one last time. When asset prices started falling and defaults rose, for example, the subprime mortgages, these institutions couldn't roll over short-term debt. That led to loss of confidence. Investors and counterparties feared counterparty default and asset quality deterioration. Even solvent institutions faced runs as market participants rushed to withdraw funds or refused to lend. That led to a run on the shadow banking system, SIVs, so structured investment vehicles, conduits, money market funds, MMFs, and investment banks lost access to wholesale funding almost overnight. MMFs experienced outflows, SIVs couldn't issue commercial papers, and repos were not rolled over, creating widespread liquidity stress. That led to collateral devaluation. Collateral used in repo markets lost value or became unacceptable. This led to margin calls, forced asset sales, and a downward spiral of declining prices and tightening liquidity, entailing the interbank market freeze. Banks hoarded liquidity due to uncertainty about their own and others' solvency. Interbank lending dried up and LIBOR OIS spreads, a measure of interbank stress, spiked dramatically. How were the liquidity issues resolved? So what measures did policymakers take? Liquidity support by central banks. The emergency lending facilities. The Federal Reserve created several liquidity programs, namely the Term Auction Facility, the Primary Dealer Credit Facility, the Term Securities Lending Facility, and the Commercial Paper Funding Facility to support commercial paper and ABCP markets. Similar programs were deployed by the ECB, Bank of England, and Bank of Japan. The expansion of central bank balance sheets. The central banks accepted a wider range of collateral, including MBS and other private assets, and the Federal Reserve provided dollar swap lines to foreign central banks to prevent a US dollar funding crisis abroad. Furthermore, the cutting of interest rates. Central banks rapidly reduced policy rates to near zero, introduced forward guidance and quantitative easing (QE) to inject long-term liquidity and stabilize financial conditions. What about government guarantees and capital support? The increase of the deposit guarantees. Governments raised deposit insurance limits to stop retail bank runs. In the US, the FDIC, the Federal Deposit Insurance Company coverage, was temporarily expanded. As well as debt guarantees, governments guaranteed new debt issuances by banks to restore access to term funding markets and the recapitalization of banks. Politically controversial, however necessary, according to the policymakers in charge like Ben Bernanke. Governments injected capital directly into major banks. For example, the US TARP, the Troubled Asset Relief Program, the UK Bank Recapitalization Scheme, and the Eurozone Sovereign Support for National Banks. What about the stabilization of the shadow banking sector? When it comes to the money market funds, the US Treasury temporarily guaranteed MMF balances to stop redemptions. The Federal Reserve created the Asset-Backed Commercial Paper Money Market Mutual Fund Liquidity Facility, or AMLF, to support MMFs indirectly, and the support for the repo markets Fed lending facilities accepted weakened collateral to prevent fire sales and repo failures. And what about the support for non-bank entities? While central banks couldn't directly support hedge funds or SIVs, as they are outside of the traditional banking systems, they indirectly stabilized markets where these actors operated by buying their assets. What were the regulatory and structural reforms that shaped the contemporary regulatory environment? These came after the immediate crisis but were aimed to reduce the risk of future liquidity dry-ups. The Basel III liquidity standards, the liquidity coverage ratio LCR, ensures banks hold high-quality liquid assets, and the net stable funding ratio NSFR aligns funding duration with asset maturities. We talked about that early in the course, as well as money market fund reforms with respect to the net asset value and liquidity fees, and increased central clearing of derivatives to reduce counterparty risks. And last but definitely not least, tighter regulation of shadow banking activities, including capital and liquidity rules for systemically important non-bank entities. To wrap up, in short, liquidity dried up because financial institutions relied too heavily on short-term funding to finance long-term risky assets. And once confidence faltered, that funding disappeared. Policymakers responded with a combination of emergency liquidity guarantees and capital support, which ultimately helped stop the panic and restore stability.